As you see in this example, we have our net sales and our interest income lumped together to give us our total revenues. And then we have our cost of goods sold, our selling expenses, general and administrative expenses, and interest expenses all lumped together. And then the net effect is our net income. It works, but the multi-step gives us a little more input, and that's why we're going to do it that way. So as you see here with our single-step income statement, it lumps together. The bottom numbers are all the same, but the multi-step gives us more detail. So what we're going to look at is the detail. So I don't want Access, do I? No, I want Excel. Come on, what did I just do? Thank you, dear. Okay, so let's create this multi-step income statement. The first thing we're going to do is show what report we're creating. I hope you remember that it's so important to always have the title of the report so we know what we're looking at. So we've got NOMAR, Noma Para Company. Is that right? Nomar Para Company. We've got the income statement for the year ended December 31st, 2014, don't we? Don't forget one of the most important pieces. Then, what's the first thing we're going to do for this multi-step income statement? Net sales. So the first thing we're going to show, net sales of $1,197,132. Then what is so unique about a multi-step income statement we're going to show? We're going to break out net sales minus our cost of goods sold is $777,080 to give us our gross margin of the difference, or $420,052, right? Right? And the net difference there is our gross margin. What's the next thing then that we're going to have in our multi-step income statement? We're going to have operating expenses. So we're going to key in operating expenses, and we've got two types. What's the first one? Selling expenses. And what are those? $203,740, and then we've got general and admin expenses, and that is $100,688, and then we've got total operating expenses that we'll put over here of a combination of these two figures. And that total is going to be the sum of 304, 428. What comes after the total operating expenses? What's going to be our next figure? Income from operations. And that is going to be our gross margin minus our operating expenses, gives us our income from operations of $115,624. Our next category would be called other revenues and, whoops. Our next category is going to be other revenues and expenses. We've got some interest income of $57.20. We've got less interest expense of $13,560. And we ultimately then have, actually, let me put that one. This will show excess of other expenses over other revenues. And if the roles were reversed, guys, if the revenues were more than the expenses, it would be excess of revenues over expenses. And then ultimately, we show the bottom figure, net income is going to be the 115 minus our 7840. Oops, I'm doing something wrong. Oh, I see what I did. $107,784. What's different between what you see in the book and what you see with what we've just created? Does it provide you with more information? It allows us to see what our gross margin is, what our net sales minus our cost of goods sold are, doesn't it? From there, it allows us to see, so based on just the selling of the product minus the cost of the product, we have gross margin of $420. It allows us to see our costs in just running the business, to come up with the whole reason we're in business is for this purpose. Here's our income from that means. And then our other revenues and expenses are ancillary to what we're in business for. How are you guys doing so far? Is that making sense? Okay. Now let's look at E6A. Okay? As we look here at the PowerPoint, we are going to talk about how we record certain transactions. Oftentimes goods get sold on a credit. And so we need to see how we're going to record these transactions. Usually speaking, when goods are sold on a credit, manufacturers quote prices as a percent off their list or catalog prices. They call it oftentimes what we call a trade discount. If an article is listed at $1,000 with a trade discount of 40% or $400, the seller records the sale at $600 and the buyer records the purchase at $600. Terms of sale usually are printed on the sales invoice and are part of what we would call the sales agreement or the sales contract. If on the invoice it shows payment is due, net 10 means the amount you owe is due within 10 days. Or if it says and 30, that means the amount is due within 30 days. Invoices can be due 10 or 30 days after the date of the invoice. If the invoice is marked N10 EOM, then what that means is it's due 10 days after the end of the month. EOM, end of month. It's common to have sales discounts if people pay early. An invoice that offers a sales discount of $210 net 30 really means the buyer, if they pay it within the first 10 days, they get a 2% discount off the invoice price. Otherwise, they pay the full amount within 30 days. Discounts are recorded by the seller only at the time the customer pays. If the customer takes advantage of the discount, the difference between the payment amount and the sales price gets debited to sales discount. So we want to record those so we can see how much is being taken with discounts. Purchase discounts are discounts a buyer takes for the early payment of merchandise. So just like in sales, sometimes we allow those, purchases are the same way. So the buyer records the full purchase price at the time of purchase. Then if the buyer pays in time to take advantage of the discount, the difference between the payment amount and the sales price gets put into an account called purchase discounts. That amount is going to help reduce our cost of goods sold or the purchases account. Whenever we're dealing with merchandise, there's usually shipping involved. Someone has to pay the shipping. So when we see the terms FOB shipping point, what that means is the seller, the one who's selling the goods, will pay for the shipping of the merchandise free on board at the point of origin, and then the buyer ultimately has to pay for the goods of the shipping. So FOB shipping point means at the place of where the goods are getting ready to be shipped, the seller gets them there, and then the buyer has to pay the shipping costs. It's important to know that the title to these goods pass over to the buyer at the shipping point. If the terms of the shipping say FOB shipping point, then the buyer assumes title to those goods at that point. If the shipping terms say FOB destination, free on board to the destination, then the seller bears the transportation costs to where they need to deliver the goods to. The seller retains the title in this case until the merchandise reaches its destination and usually prepays the shipping costs. So basically, in that case, if the seller's paying the shipping, the buyer's not going to have to worry about any shipping. FOB shipping point means the buyer's going to pay all the shipping costs at that point of the selling destination. If it's called FOB destination, then that means the seller is going to pay the shipping costs. The title always is correlated with who's doing the shipping. Okay? When the buyer pays the transportation charges, we call it freight in, and it gets added to the merchandise purchased. Think of it this way. Having to pay for shipping costs is part of the cost of getting those goods to the store, isn't it? When the seller pays the transportation charges, it's called a delivery expense, and that gets included under that category selling expenses under the operating expenses, it's going to be recorded there. So let's go back to E4A or E6A, and let's look at this problem, okay? So we're going to go through using a perpetual system. We're going to start learning how we would record these various types of transactions. July 2nd, purchased merchandise on credit from Green Company. Terms 210 net 30, free on board to the destination. Invoice dated July 1st, 2000. Can anyone tell me what that means? We are the purchasing company here. We purchase merchandise on credit from Green. Terms 210 net 30, free on board destination. Who's paying the shipping costs here? The seller is paying the shipping costs. We don't have to deal with shipping. Did we give them cash or do we owe them money? We owe them money. So let's go and figure out how we're going to record this. So wouldn't it be that this date is July 2nd? So the first thing we'll do, July 2nd, we're going to have a term when we're using the perpetual system, merchandise inventory, okay? And we are increasing our merchandise inventory by $2,000, right? And we owe them money, don't we? So we're going to credit accounts payable for $2,000. Now this explanation is we purchased merchandise on credit from Green Company, terms 210 net 30, FOB destination, invoice July 1st. Okay? Any questions there? Net. So in other words, if we pay this invoice within 10 days, then we get a 2% discount. Okay? Or 20 bucks. So we would really have to only pay them $1,980. Otherwise, we must pay the full amount, the full $2,000 within 30 days of our invoice date. So N means net. N means you pay what you owe within 30 days. It's a term that's just commonly used in accounting, kind of like debit or credit or DR, CR. It's like, why do you say DR or CR? It's just been a standard. That's a standard term when we're dealing with the payment of invoices. This is it. 2 means a 2% discount if you pay within 10 days. Otherwise, you pay the whole amount within 30 days. Okay, the next one says, we returned some merchandise to Green for full credit for $250. So what's happening here? We didn't keep it all. Yes, merchandise inventory, what's going to happen? Payable. Goes, yes, perfect. So on July 6th, we're going to debit accounts payable for $250, and we're going to credit merchandise inventory for $250. And our explanation, returned some merchandise to Green Company for full credit. That's easy, isn't it? Okay, next one. Paid green for purchase of July 2nd, less return and discount. So what they're telling us is on July 2nd, we paid green for the purchase, less what we returned, and we took advantage of the discount because we paid for it within 10 days, didn't we? So on July 11th, we can debit our accounts payable for the full amount. We owed them $2,000, but we returned $250, so our accounts payable should be zeroing it out for $1,750. Now, we owed them $1,750, but we took advantage of the 2% discount, okay? So let's just go down here and show this. The 2,000 minus the 250 is 1,750. 2% discount on 1,750 is what? $35. So if we pay them within 10 days, we get to reduce it by $35, don't we? $1,715. So our accounts payable, we're going to zero out because we don't owe them that anymore. We're going to show as a credit purchase discounts of $35, and then we're going to show a credit to cash of $1,750. And we're going to show we paid Green Company for the purchase of the July 2nd, less the return and the discount. We always want to zero out our accounts payable because we don't owe them anymore. But we want to keep track of the discounts that we've taken advantage of. So we record that discount in an account called purchase discounts, which will help reduce the purchase price on the goods, won't it? And the difference is going to be cash here. Okay? Next, it said, we purchased on July 14th merchandise on credit from Green. Terms 210 net 30, FOB destination. Does that mean we have to pay for the shipping, or do they? They do. Invoice dated July 12th of $2,250. So we're going to do the same thing we did on July 2nd, aren't we? We're basically going to show on July 14th that we purchased merchandise inventory of how much? $2,250. So we'll debit our merchandise inventory of $2,250. We'll credit our accounts payable of $2,250, and we just say purchased merchandise on credit from Green Company terms 210 net 30, FOB destination, invoice dated July 12th. Pretty simple, isn't it? The key here is understanding the accounts we're using for this method. We debit merchandise inventory when we pay for the goods, and we take a discount. We create a purchase discount to keep track of those. Then On July 31st, we paid the amount owed to Green for purchase of July 14th. Did we take advantage of the discount? We didn't. So all we're going to do on July 31st, we paid him, we debit our accounts payable for $22.50, and we credit our cash for $22.50, and we show the paid amount owed Green Company for purchase of July 14th. Okay? Make sense?
So there's an account called
Purchase discount. Perfect. Yes. For the perpetual method, yes. Okay? How are you guys doing so far? Yes.
Why at the bottom of the page it has the actual computer together?
Okay, so let's go back and finish that. I wasn't going to, but
Well, I guess I just don't know where
it's okay. Prepare journal entries. It says there, determine the total amount paid to Green.
So you just add the two together.
We add the two cash. The two cash is how much we paid Green. Now, let's go back and look at the periodic system. So we have created and gained an understanding using the perpetual system, how we use those accounts, merchandise inventory, and then if we pay items, we show it as a purchase discount. So we are constantly going to keep track of our cost of goods sold. And if we have to pay for freight, that will be included in our cost of goods sold. We've done that, we've done that, we've done that. Okay. What I'd like to do is still stay under this method, the perpetual system, but let's show it on the other hand. That example showed how we purchase goods. Let's show how we sell goods under this method, okay? E10. Is that okay? I just want to stick with what we're doing instead of confuse you yet. E10, what we're going to do is record sales under this same perpetual system. On November 15th, TCS Company sold merchandise for $2,600 on terms of net 30 to Quaker Company. On November 20th, Quaker returned some of the merchandise for a credit of $600. And on November 25th, Quaker paid the balance owed. We're going to use T accounts to record the sale, the return, and the receipt of cash under the perpetual inventory system for TCF. The cost of the merchandise sold on November 15th was $1,500, and the cost of the merchandise returned to inventory on November 20th was $350. So let's start by talking about the November 15th transaction. The November 15th transaction tells us that we sold merchandise to Quaker Company for $2,600 on credit because we're not going to get paid for 30 days. And that product that we sold cost us $1,500. Okay? So let's start by creating some accounts here. You bet. 1 second here. Okay. We sold on November 15th $2,600 worth of merchandise to Quaker Company. But it cost us $1,500. Am I right? $1,500 is what it cost us? So I'm going to match mine with yours. The first one is cash, right? And then this one is sales. Then we have accounts receivable. We have something called sales returns and allowances. Then we have merchandise inventory. And then we have cost of goods sold. Can you guys see that okay, or is it too small? So I am going to create the journal entry so you see it, but our job really isn't to do a journal entry here, it's just to post it. So when it says to us, on November 15th, TCF sold merchandise for $2,600 on terms net 30 to Quaker, and the cost of it was $1,500. So I'm just going to do the journal entry so you can see it. The journal entry would be a debit to accounts receivable, right? This is November 15th. Accounts receivable would be how much? $2,600. And the credit would be, what would the credit be? Sales for $2,600, right? But we have another step here. We need to take that out of inventory and show it sold, don't we? So the next thing we need to do on this same day is to debit cost of goods sold, because we keep track of a perpetual method. We always know where we stand. Cost of goods sold, it cost us $1,500, and we credit merchandise inventory for $1,500. Now, why do we do that? It stays in our merchandise inventory, and it's inventory until it's no longer inventory. And what does it become? Now it's cost of goods sold, right? So we have these Coke cans. Right now, it's sitting in inventory. And so the minute I come in and buy these 2 Cokes for $1 a piece, okay? The Coke cash is debited for $2. Sales are credited for $2. But that's not the whole story. It costs the store 30 cents a can. Okay? I'm taking these out with me. Right now, these are showing as inventory. They're sitting on the shelves. The minute I sell them, yeah, I gave $2 for $1 each Coke, and they have sales, but we also have to show these are no longer sitting on the shelves, are they? Because I took them out. So there are two transactions that take place when we deal with manufacturing companies or merchandising companies. We also have to show the cost of these items. $1 is what I paid for them. They sold them to me for. But we have to show these aren't on the shelves anymore. They're cost of goods sold. So the second step we have to do is take those goods out of merchandise inventory because they're not there anymore and show them as cost of goods sold. Now we use the price we paid for those goods. We show in sales and accounts receivable what we're going to receive, what we sold them for. But our cost, our merchandise inventory is what we paid for them. So we have two transactions when we sell goods. We have to show the accounts receivable or the cash and the sales, but we also at the same time have to show the merchandise inventory going down and the cost of goods sold going up. Okay, so that is the journal entry, but that's not what you have to do. Our job is to record them. So what we're going to do under sales here, we're going to show $2,600 on November 15th, right? And we're going to show accounts receivable on November 15th of $2,600. We're also going to show our merchandise inventory got credited on November 15th, $1,500. And on November 15th, our cost of goods sold got debited $1,500. Does that make sense? Both transactions have to happen. Because we're not just dealing with the service, we're having to show not just the sale of that inventory, but what we paid for it. It's no longer an inventory, it's sold. The next one says, on November 20th, Quaker returned some of the merchandise for a credit of $600. And we know that, so the amount they bought that returned merchandise for was $600, but the cost of the merchandise returned to inventory was $350. So let's think of how that journal entry would play out. On November 20th, our sales isn't what we thought it was it? We've got now something, because we want to keep track of how much stuff gets returned. So we're going to create an account called Sales Returns and Allowances of $600, aren't we? And our accounts receivable goes down $600, doesn't it? Because they're not going to owe us. They gave it back to us. Likewise, on this same date, we also need to show that our inventory has gone back up, hasn't it? And what we thought we sold, we didn't sell. So we will then debit our merchandise inventory of $350 and credit our cost of goods sold of $350. We didn't sell it anymore, did we, guys? Make sense? Well, this accounts receivable is an asset. Sales is income. Cost of goods sold is technically an expense. So we don't have any liabilities right now in this problem, but yes, each one of these accounts is either an asset or a liability or revenue or expenses, right? So in this case, since they owe us $600 less, we get to credit accounts receivable for November 20th, don't we? We also will show a sales returns and allowances of $600 for $600. Then we also have to show that we have $350 back into our merchandise inventory, and our cost of goods sold has gone down $350. Does that make sense? Next, Quaker paid the balance owed on November 25th. Now, did he take advantage? No, there was no discount to be taken. So on November 25th, he paid the balance. How much does he owe, guys? $2,000? He owes $2,000. So let's think of this journal entry. On November 25th, we received cash of $2,000. And does he owe us any more? No. Accounts receivable gets credited $2,000, doesn't it? So we go up here and we show cash $2,000 on November 25th, and our accounts receivable gets credited $2,000. We don't do anything with inventory because all that happened is we got paid. Any questions on that? It's kind of making sense? Okay. Now let's go and talk about the periodic system. The periodic system handles it a little differently because we're not constantly keeping it updated. Under the periodic system, cost of goods sold has to be computed on the income statement because we do not keep it updated at all. Cost of goods sold are the items that we've actually sold. Cost of goods available for sale are those items sitting in inventory, okay? So cost of goods available for sale is the total cost of merchandise that could be sold during the accounting period. Cost of goods available for sale include merchandise that's on hand at the beginning of the period, plus any purchases we purchased during the period. The difference between cost of goods available for sale and cost of goods sold is the amount that wasn't sold at the end of the year, or what we would call the item sitting in ending inventory. Okay? This shows us a periodic inventory system income statement. You'll see under this method, we don't keep up with it after every purchase. So the way we calculate our cost of goods sold is we have to start with our beginning inventory, or what we should say the ending inventory from the previous year. We add to it all of our purchases during the year. We subtract from it any purchase returns and allowances we have. to have then our net purchases. We add to it freight in that we had to pay for because we purchased goods and we had to pay for the freight. Gives us our net cost of purchases. So if we take the beginning inventory plus all of our net purchases, that's everything available for sale. When we physically count our ending inventory at the end of the period, the difference then will be our cost of goods sold. See, since we don't keep track of it after each transaction, we have to figure it out at the end of the year. You can imagine the negative with that. And the way we figure it out is fairly haphazard in that we just plug in the figure. We plug in the figure based on beginning inventory plus all of our purchases minus what's on our shelves at the end of the year. We assume the rest was sold because we don't have it anymore. Does that make sense? So the way this works, we start the year with so much on our shelves. We purchase goods throughout the year, which are our purchases, plus any freight, minus any returns and allowances, which gives us everything available for sale. Then what's sitting on our shelves at the end of the year, we show here of $193,200. That's going to get carried into the next year. The difference between all of our goods available for sale minus our ending inventory, the difference is what we sold because we don't know what else happened to it. Does that make sense? So as you see here, under this periodic system, we're going to show purchases, we'll show purchase returns and allowances, and we'll show freight in. The difference between this periodic system and the perpetual system, remember under the perpetual we called it merchandise inventory? Remember that? We don't do that here. We started with beginning inventory. Any purchases we record in an account called purchases. So let's do a problem. We can go through the PowerPoint, but sometimes it's helpful to just do it. So let's go and look at a problem. Actually, you know what we're going to do before we do? We're going to create the income statement using the periodic system. So a lot of those different accounts we were talking about, let's create one. Let's look at E11A. Okay? Using the selected year-end account balances at December 31st, 2014 for proof general store that follow, prepare a 2014 multi-step income statement. Show detail of net sales. The company uses the periodic inventory system. Beginning merchandise inventory was $26,000. Ending merchandise inventory is $22,000. So it gives us our various accounts if they're debited or credited. So what we're going to do is we're going to go back to our income statement. That this one was created just showing cost of goods sold under the perpetual method. We're going to do E11A, and we've got proof general store income statement for the year ended December 31st, 2014. Okay? The first thing we have are net sales, and we're going to determine our net sales by taking the sales of how much? And anyone see what the 297? Okay. The sales were 297, and we have to take from that the sales that got returned and allowances. So less sales, returns, and allowances of how much? 15.2. That becomes our net sales. The difference between those is our net sales, which is 281,800, isn't it? Then we've got our cost of goods sold. Now this is going to be a little trickier. It's not trickier, it's just because we don't keep track of it throughout the year, we've got more steps right here. To figure out our cost of goods sold, we start with the merchandise inventory as of December 31st, 2013, which is really the January 1st, 2014. How much is that? $26,000. Okay? Then we add to that our purchases. How much were our purchases during the year? $114,800. Then we have to subtract less purchases, returns, and allowances of how much? $4,000. So our purchases minus our purchase returns and allowances give us our net purchases of $110,800. Now we need to add to that what we paid for freight. Freight in is how much? $5,600. So what we're going to do here is our net cost of purchases is going to be the combination of the 110 plus the 5,600 is 116,400. Okay? So then cost of goods available for sale is going to be the sum of our beginning inventory plus our net cost of purchases, our 142,400. See that there? Then what we do is we show less merchandise inventory on December 31st, 2014, which was 22,000. The difference is our cost of goods sold. So as you see, we had available for sale 142,400. We had on hand at the end of the year 22,000, which means we didn't sell 22,000 of everything on our shelves because it's still there. which means the difference we did sell. So we have cost of goods sold of $120,400, which means our gross margin is going to be the difference between our sales minus our cost of goods sold, or 161.4. Do you see how I'm using these three columns to just keep track of my additions? Okay? Don't get caught up in, am I putting everything in the right spot? It's just a manner of you, because we've got so many accounts we're dealing with, we're using these various columns just to add the numbers and flow them over. So our gross margin is at 161.4. Then everything else is going to stay the same. Our next step is operating expenses. We've got selling expenses of 48.5. We've got general and admin expenses of 37.2. And from there, total operating expenses of 85.7, which means ultimately our net income should be 75.7. $161.4 minus 85.7 should be 75.7. How you guys doing? So guys, for you to do problem 1 and 2, you have everything you need to do problem 1 and 2. Prepare a multi-step income statement showing percentages of net sales for each component, which basically you'll always take the percentages based on net sales will be 100%. And then problem 2, using the perpetual system, you're going to prepare a multi-step income statement. Okay? Absolutely. Sure. So okay. To get our net sales, we took sales minus sales returns and allowances to give us our net sales. Our net sales minus our cost of goods sold gives us our gross margin of 161.4. Our gross margin minus our operating expenses gives us our net income. Make sense? I'm sorry, what? Gross margin is sales minus cost of goods sold. So the way we calculated our sales was our gross sales minus our sales returns and allowances gave us our net sales. Now to calculate our cost of goods sold under this method, we had to start with the beginning inventory, add to it purchases, subtract from it purchase returns, add our freight in, subtract our ending inventory to come up with our cost of goods. You see how it's just a little more complicated here? So our net sales minus our cost of goods sold gives us our gross margin. Okay? You know what I'm going to do, guys? Instead of doing P1 and P2, we're just going to do P2 and P3. So I'll fix that for you. Do you want a break?